It comes down to capacity to pay. And all our analysis leads us to, when we look at the housing market and interest rates generally, and the affordability that's knocked on from that, is that house prices are very, very correlated to interest rates. So as interest rates come down, house prices go up. That is no surprise to us. What's happening is, now that interest rates have gone down so far, the market is starting to get concerned about, if interest rates rise, what is the ability for those borrowers to continue to pay given the amount of debt they've come on. So where we sit today in terms of interest rates, mortgage rates in particular, it's actually quite affordable. And that's being backed up. If you look at the industry market, where they're saying, in terms of S&P and Moody's, the people that rate these types of vehicles, they're saying that the arrears rate, the mortgage arrears rate, the borrower that's in difficulty, is actually quite low. When we also look for other evidence, if we're missing something in a lot of our analysis, we're looking to the banks and looking at, is there any increase in their loss provisions in terms of their balance sheet? And what we haven't seen is, we actually haven't seen this stress, and that's because rates are low. So yes, with mortgage rates at this level, do they have capacity to pay? Yes. If rates start to rise, we start to believe we'll see that uncomfortable rise in delinquencies, arrears, provision for doubtful debt start to increase in the bank's balance sheets. But where we are today, there is capacity to pay. What's happening in the industry is the regulators got in front of it here, and what they've done is they've seek to address that. So when a borrower goes to get a mortgage, what they're looking to do is they have to get assigned what they call an assessment rate. The lender looks at the borrower and says, okay, what is my comfortable lending rate to you for the risk that I'm taking? Then, because that's a function of interest rates, the regulators stepped in to say, well, no, if the rates start to move higher, because we are a standard variable, as rates rise, our mortgage rises, we need to look after our borrower and to make sure that there's a sufficient buffer built into their mortgage rate. So it's assessment rate plus buffer. Once we get out to that level, the new loans getting written after this has been put through, we see these loans will be able to perform. However, proof will be, once the rate actually starts moving that way, what will be the impact? We see that it will be increasingly difficult in terms of the market to assess this. However, we believe ultimately, in the history of losses and the delinquencies since we've been managing it, since 2000, 2002, which our delinquency goes back to, we see that the market will be able to continue to withstand an increase in interest rates.